Welcome to today's presentation where we have the pleasure to present OrderYOYO. To help us through today's presentation, we are joined from the company from CEO Jesper Johansen and CFO Jesper Hyveled. Today's event will cover your H1 half-year report you sent out last week. As always, there will be possibility to ask questions. Do it in the box down below. Do it in Danish if you feel for it. I will try and translate to the best of my ability. But I think for now, I will hand the call over to you, Jesper.
Yes, thank you, Michael, and welcome everybody to this half-year presentation by myself, Jesper Johansen, CEO, and Jesper Hyveled, our CFO. The overall numbers we've sent out before, so that was sent out in our current trading update in July, but this is the more detailed half-year presentation. We'll go a little bit more into details with how the actual numbers are composed. Let's get going, Michael. Next slide, please. And as always, just 10 seconds here, 30 maybe. And let's move on now. I'll start the presentation. So before I'll hand over the word to Jesper to go through the numbers, just very briefly, so that everybody is totally clear on what we're doing. So we do white label software for the takeaway industry, liberating your local independent takeaway restaurant. Up to 90% of orders in a takeaway restaurant is recurring customers that the takeaway restaurants have to claim back from the food portals that right now are doing a lot of the digital servicing of these restaurants. And the food portals will normally charge between 15 and 35% of commission, whereas OrderYOYO has a price between 5 and 9%. So both from a cost point of view and from a customer point of view, the restaurants need to engage with us as providers of white label software to make sure that they can handle their own customers. We're the market leader in Europe, including the two largest markets in UK and Germany. ARR of 302 million, growing 23%. And we have, for the last 3 years, been on a profitability path where we have steadily increased profitability. Yes, we'll talk a little bit about it into this later. And in the first half of 2024, our EBITDA grew 153% compared to the first half of 2023. That was the intro. So over to you, Jesper.
Thank you, Jesper, and I will give you the highlights of our first half performance. So next slide, Michael, please, and then one more. So these numbers were already presented in our current trading update, but I will just briefly go through them again. So our annual recurring revenue of June 24 increased by 23%, reaching 302 million, as Jesper just alluded to. Our first half net revenue reached 148 million, versus 116 in first half of 2023. That's an increase of 28%. Our June GMV increased by 26%, reaching 2.9 billion. And then our first half EBITDA grew 153% from 9 million to just below 23 million. And then finally, our new KPI here, our cash EBITDA, grew from a loss of 5 million in 2023 to 10 million in first half of 2024, an improvement of 15 million, and something that we will continue to focus on, and we will get back to that in a later slide. Next slide, please, Mike. So taking a closer look at our ARR composition, first looking at our split between fixed and usage-based ARR, what we believe is a very healthy split here with 39% fixed subscription and 61% usage-based subscription. That gives us a good balance with a market that is impacted by seasonality. And also, if we look at the right side of it, we also have a healthy country split with now GB and Germany contributing with 75% of our total June ARR 2024. Next slide, please. Again, looking at our ARR composition, we have a very low ARR churn. We are focusing very hard on our ARR churn or MRR churn. In the first half of 2024, we have kept our ARR churn low and adding new partners to our estate, contributing to the overall ARR growth. On existing customers, the drop is reflecting seasonality in the market and something that you have also been seeing in the past. So again, a healthy development. We are doing a lot on our estate health. We are working on it daily in our commercial department, and we are seeing the effort paying off here now in our continuous low and dropping ARR churn. Next slide, please. So as we grow our top line, we also grow our profitability. Here shown as our quarterly EBITDA development. The profitability improvement is a result of top line growth, strong operational leverage, and our historic M&A that we have done. We'll continue to focus on this path towards profitability, and we expect to continue this journey throughout the year with improved margins in second half as well. This was the final comment from my end, and then over to you, Jesper.
Thank you, Jesper. Next slide, Michael. So just brief comments on market leadership and why this is important. If you take the next slide, Michael. So since 2018, just pre-COVID, we have actually increased the ARR of our company by more than 10x. So from 30 million in 2018 to now 302 million annualized in Q2 2024. We started out as a traditional venture case with a heavy focus on growth, but in the last years, we've also introduced profitability as a measure, as Jesper just alluded to. But this 10x in revenue is actually also what has driven us to being number one in Europe. If you take the next slide, Michael. And our approach to becoming number one, we have always had a very focused strategy, meaning that we wanted to be number one or number two in any given country instead of spreading out to a lot of different countries. So very early on, we decided to focus on UK and Ireland. UK is the biggest takeaway market in Europe and become number one there. And with the acquisition of AppSmart, we became number one in Germany, the second largest market in Europe. And we're number one in Ireland, in Austria, and in Denmark. And all markets that we want to enter, we want to claim a market leader position. We do believe that the ability to be number one has a lot of competitive advantages, both in terms of product, but also in terms of market. Next slide, please. And the way we want to enter new markets will still be by M&A instead of starting from scratch. We want to acquire new markets by acquiring number one or number two in any given market, as we did with AppSmart. Also, we want to acquire and have an active M&A strategy still in the existing markets, especially Germany and UK, where buying smaller, local, strong performing companies will give us even further scale in these two markets and drive economies of scale and profitability. Next slide, Michael. And as we just explained in the half-year report, we have in August secured an additional debt facility of 70 million, bringing the total cash to 138 million. And this gives us flexibility in funding of the acquisition targets. So now we can actually, we've until now paid in shares, still very important metric for us, especially to secure that the founders are locked in. But now we also have the possibility to pay in cash or a combination, both if it makes sense for the seller, but also if it makes sense for us as acquirer. If we do feel that dilution of our shares is not interesting, we now have the ability to pay with cash. So that's very, very important for us. Next slide, Michael. This brings us to the 24 outlook. So we raised that in the current trading update in July to ARR of 325 to 335 million, net revenue of 290 to 300 million, and profitability increased to 45 to 50 on EBITDA, and cash EBITDA 17 to 22 million. So we do see strong performance in the first half of 24 and has therefore increased the guidance. Next slide. Especially profitability has kicked in, and we have in the last 2, 3, 4 quarters seen that the activities that we do in terms of profitability has really paid off, and we now see quite an increase in EBITDA, and therefore have increased our EBITDA guidance quite significantly. Our original 24 guidance was that we were to hit a EBITDA margin of somewhere between 9 and 11%, and now we are guiding to 16 to 17%. We introduced our long-term EBITDA goal of plus 25% back in beginning of 23. At that point in time, 25% seemed like an ambition target. We could see that we would reach it, but it was ambitious. And we can see that we are much closer to that now than we anticipated back in the beginning of 23. So strong profitability. Next slide, Michael. That was actually it. So now over to you, Michael, on Q&A.
Yeah, perfect. That was my cue. The first question, can you still find efficiency gains in the organization and from earlier acquisitions? You know, you're growing your revenue much faster than your cost base. So are you hitting any bumps, capacity strains there to keep pulling out some more efficiency of this?
Yeah, let me answer that. We are constantly looking at optimizing our way of working, and we do have work smarter initiatives, and we are globalizing more and more functions. It's not something that we want to do just overnight, because there's also risks associated with just globalizing from day one. So we are doing this in the right sequence here, and we are trying to do this every day. And the short answer is yes, there are still opportunities, and we are looking at those constantly. Another important message here is that as we grow, we also have a stronger position when negotiating contracts on bigger cost sides, and that we are obviously also that will also help us. But here again, we also under contracts here, and that comes as new contracts are to be negotiated. But yes, we will be harvesting some of those efficiency gains in the months and quarters to come. And
I could see you also growing very healthy on the gross margin side, you know, all your running cost and such stuff. Is it 85 now, up from the start 80s a while ago? Will the bigger size and what you are talking about, the negotiating of contracts, will that also keep lifting this one, or because it's already a pretty healthy one looking at a SaaS company?
Yeah, I think here it's important to understand also the composition of our net revenue, because we also have and see hardware sales within that. It's not the last portion, and obviously the margins on those are way less than in our main business. But yes, the main cost of goods sold, which is transaction fees on our transactions, we do see lower cost per transaction, and that is simply due to the fact that we are globalizing and migrating into our platform, and that leaves us with larger transactions. In total, our GMV increases, and thereby we have a stronger negotiation power towards our PSP. So all in all, our gross margin looks healthy. As we hope to expand our product offering all the time, we might start reporting on various gross margin types, because it can be messy if we are constantly looking at the gross margin just as one number. But yes, right now we are just below 85%, as also mentioned in our financial review in the annual in the half year report.
Perfect. And then there are some questions about the M&A, and which which had to come with your stepping up on your credit facilities. What are your thoughts in relation to financing and size of M&A targets? Taking those debt facilities into, should we see this as a sign as you're stepping up from targeting more the bigger acquisitions than the bolt-on in existing markets, or is it simply we shouldn't read too much into it, but it's you preparing for the future when it's possible to get some credit lines?
Yeah, I think first of all, it's about flexibility. We've been able to, because of our profitability path and profitability measures, we've been able to secure debt facilities that are attractive to us and also for the shareholders. So this is basically ensuring that we have the flexibility to do what we want to do. In terms of targets that we are looking at, it's actually still the same. So we still see bolt-on acquisitions, and we also look at new markets. There's no doubt that the bolt-on acquisitions are the ones in terms of if you can talk about risk profile, where the risk profile is the lowest. It's the easiest for us to take out EBITDA margins and increase EBITDA margins, and there are definitely more of those than of the other ones. We do look at both. The size of
sorry. No. And then I don't know whether it has changed. Of course, you have always been able to use cash, but you have changed it from now cash and shares. Should we read anything into that, or should we read in that pricing of your share versus your now credit market actually makes it more profitable or a better deal to use more debt to finance those acquisitions? Is it more that way we should see it, or is it some change otherwise why you maybe are thinking about using more debt than your own share?
Yeah, I mean, obviously we can't comment on whether we think that where the share price of the company is. But additional debt gives us flexibility. We think that it can be interesting for the shareholders of OrderYOYO for us to be able to do acquisitions without being dilutive in terms of number of shares. Number one. Number two, now we've done 3 acquisitions and we've integrated them, and I can see that our M&A framework works. So we're not that afraid to do it with debt that we probably was before. So it's also a matter of we do not see that acquiring companies with cash increases risk significantly, because we know what to do with the companies that we acquire. So I think it's a combination of those two.
Yeah. I guess last question, there's a question here, is it existing or new European market? And I think you answered that it's both you're looking at. Is that correct?
We're looking at both.
Yeah, perfect. Then in their latest public available statutory accounts, one of your biggest competitors, Flipsys, are posting net revenue of 18 million euro and a loss of 27 million euro. Are you aware of these numbers? And if so, are they comparable to the numbers you present for H1? I don't think comparable is, I think accounting wise or something like that, because you present a profit and they present a loss, but maybe if it's comparable, the way you take your cost in and the way how much of the R&D is capitalized and so on. Are you aware of whether there's any differences between
we do know the numbers, and especially on the revenue, it's basically very, very easy to cover one-to-one. So they have revenues of 18 million euros, so just below 130 million, and we have of 300. So that basically shows the difference in size. Profitability-wise, as I understand it, they do not capitalize R&D. So this would probably be looking at cash EBITDA, where we have between 2 to 3 million euros, where they're losing something like 26 million euros.
Yeah.
So and I think we've touched upon this last time, and great stuff that somebody has found the annual reports. I think it's a company wants to understand the position of our biggest competitor. It would be fine to look at their annual accounts. they're freely available.
And then let's look a little bit out on the space where you're looking at in Europe, and the map you are drawing there, you must use another color than green, because when you have taken over all the European markets, we can't see that because you use the same green. No joke. Yeah. But is it profitable companies out there you're looking for? If you need to use debt, or is it a little bit like Flip This that you are looking at, that you need to go in and do a lot of you might say get some synergies out to get them? How is the picture out there with looking at the markets where you're looking for consolidation partners?
It's a very good question. So there are two types of companies out there. You have some companies that have been financed by venture capital over the last 3, 4, 5 years, like Flipdish, that are heavily loss-making because they have introduced a model where cash was free, and therefore have not a structure in their cost in their cost that makes sense from a profit point of view. Those companies we are not that interested in acquiring. There's a lot of work with them. Obviously, if we were to buy it at a very big company, it could be interesting. But the cost synergies that you need to take out are quite high. Number one. Number two, these companies, because they're VC backed, normally have a tendency to have very high price expectations, because some of these investors still think that we're talking 7, 8, 10 times AR when acquiring companies. So that's the first set of companies out there. Then there's the other set, which is for us the most interesting one, which basically is very much along the lines that we have acquired AppSmart, Kingfood, and Costuco, which are companies that are founder-led, haven't had a lot of funding, so they have been forced to drive a cost agenda in the sense that they needed to earn as much money so that they could cover their cost, and they are more or less balancing in terms of profit. Now these companies are the ones that are very interesting for us, because there we can do a lot by integrating, and the baseline for these companies are right. So the mindset of you just can't use cost and money as they were free is there to begin with, which is very, very strong. Just add something here.
Yeah, just to add, so everyone needs to know and understand that we have had the opportunity to acquire a lot more companies than we've actually done, but our due diligence and our measures and our requirements are very high, so we do not want to engage with all. Our due diligence is very, very detailed, and therefore we are only taking the ones that we have a certain trust in, that we can actually turn into a profitable business, and that adds strategic value to OrderYOYO. And therefore the pace might seem slow, but we are actually looking at a lot of companies, and we want to do the right ones only, and that's why it takes some time.
Yeah,
perfect. Is it possible to give some ballpark numbers on what you can grow your existing customer base with?
It's not something that we guide on, so I'm a little hesitant here to give specific numbers. I think if you go back to the slide with the build up, that one, yeah. So from January, sorry, from June 23 to June 24, it basically shows the net growth in so the net revenue retention of our current business is probably between 100 and 105 if you do the math. That's also the numbers that we are seeing. So the current customers that we have are trucking along at a pace of 105 or something like that, and then we on top of that add new restaurants all the time. Obviously, there is an opportunity here to increase the product offering to these existing customers. So we have POS, we have RDS, so restaurant delivery services, and the whole idea of creating more front of house products to sell into the current base is something that is growing on us. That will increase net revenue retention. But we do see fine growth in so net revenue retention of between 100 and 105. Maybe 110 in some month on the existing customer base. Anything to add?
So that is the level that you have seen for some while, and
yeah,
it should be, if for modeling purposes, if you might say that's a reasonable ballpark to expect. It's not where you achieve your main growth from. That is adding new customers.
But now Jesper here, I think it's important to understand that this is like for like. It's the same product offering more or less that you're looking at here.
Yeah.
But as Jesper said, we are constantly looking into offering a bigger, a broader band of product to our restaurant partners, and that is obviously also to be able to grow existing restaurants, but also to be the preferred partner, and that will add growth to existing customers, and there are opportunities there for sure. And that's also why we continuously invest heavily in our product and will continue to do so. So that could be a growth contributor, definitely on existing customers.
Then the next question: with normal seasonality, your current guidance does not indicate the same rise in activity as normal in the second half. Is this cautious, or have you seen something change in the market?
We haven't seen any changes in the market, and quite right that second half, especially from September, October, and the year out, are very strong takeaway months, and we expect that to happen as well. So the guidance is a matter of being cautious. Anything to add, Jesper?
No, but looking at the GMV growth that we expect to reach our guidance, it suggests a healthy growth, but there are definitely opportunities there. But again, it's looking at the slide with where you have the usage-based subscription. We are dependent on the market, and therefore our growth rate in our GMV and thereby our ARR is reflecting that. But we do not see any changes, as Jesper said.
Perfect. And then a final question. When you use this M&A when you use your share as an M&A and have done that in acquisition, it also means that some shares end up by some big shareholders. Are you thinking anything about a strategy if you want to do that more in the future, where larger shareholders can take that over if those investors don't want to stay maybe for 10 years after you acquired their business or something like that? Are you making any plans, contingencies to think about when you use your share as an M&A?
I mean, what we do is we normally do lock these investors up. I think the only one where you've seen quite a big dilution was when we acquired Aftermath, where we issued new shares of around 30%. I think both in Gustoco and in King Food we're talking about less than 1% point, which of course can do something with the shares, but we lock the sellers up. Obviously, if we have situations where it's very, very clear that we will see a big overhang of shares, we might want to do a bit more in cash. That's also the flexibility.
Perfect. I don't think there's any more questions. Thank you to you, Jesper and Jesper, for taking us through your results and the full sets of results. And thank you for answering some questions, and thank you for the audience listening in.
Thank you very much, everyone.